years. So it's good to see you again.
Well, less than that, Brian. You've been avoiding me for some reason. I don't know why.
Well, you didn't want to get up at 4 in the morning on my previous show as my guest, but good to see you here nonetheless. Listen, I feel like European financials, it's like that sign in Irish pubs, free beer tomorrow, but it's always today. Tomorrow never comes. They've been undervalued for so long. We saw what happened with Credit Suisse. When do they get some love? Is there a catalyst that needs to happen?
Well, yeah, there has been a little bit of love over the last 12, 18, 24 months. They've done pretty well, but the main catalyst is what we've seen happen since the global financial crisis, when banks had to rebuild capital and you had this negative interest rates, which in essence was a headwind, especially in Europe where you had negative rates. And really the catalyst is interest rate normalization. I mean, now that we have interest rates going to 3.5%, 3.75%, 4%, you still have some growth in assets, growth in lending. You have very restrained costs. You have rising fee income. And most important, Brian, most important is these companies are overcapitalized. What this means is everything that they earn, they can either plow some of it back into growth, but more importantly, give it back to shareholders in terms of dividends and stock buybacks. And this is exactly what we see happening literally with every major financial that we own, and just about every financial in Europe is so overcapitalized that what they're generating today, which is good free cash, is being distributed back to owners. So speaking of free cash flow yields, we're well into the low double digits, 11, 12, 13%.
All right, so we know you like a Lloyds, not a pure play financial, obviously a very kind of unique leader in insurance and maritime and a lot of things like that.
This is, this is Lloyds Bank.
Oh, it's Lloyds Banking Group. Fantastic. Okay, good. Well, it's kind of a new name then.
Yes.
I was looking forward to going down the path of like Admiralty Insurance. So this is a good thing. Who is Lloyds Banking Group and why do you like them?
Well, Lloyds Bank is probably the single most, I would say, important banking franchise in the United Kingdom. They specialize in kind of higher net worth, SME banking, and they're just in the United Kingdom. They don't have, it's not a universal bank. It has a somewhat narrow niche and a very strong and loyal deposit base. You know, probably mid-teens of the deposits in the UK banking system, if not higher. So it's a good, well-run, conservative bank that in the next 5 or 6 years, barring any big shocks, they basically will return their enterprise value to owners in dividends and stock buybacks. So good, stable business franchise, efficient at costs, very well capitalized, and very shareholder-friendly capital return policies.
Yeah, another company, I guess similar. Would you consider an Allianz? Not exactly analogous. I get that, David, but an Allianz, very well known to our viewers. But what makes their business attractive to you as a stockholder?
As a stockholder, you have a situation where Allianz, of course, is a big global insurance company. That also owns PIMCO. So 25-ish% of its value is from PIMCO, and the rest of it is selling mostly P&C insurance. And again, very well-run company, low 92s, 93s combined ratios, hugely cash generative. Again, and like I said about the other European financials, distributing large sums of money to the owners. I think this is the theme. They're very well run, very low in costs, very good at managing claims, and as a result, they have all the surplus capital which they're distributing. And then again, with higher interest rates, this lends itself to better investment income. And
we recently interviewed the new-ish CEO of CNH, Scott Wine. He was the CEO of Polaris here in America. Now he took over CNH, which people don't realize, Case New Holland. They make tractors, a John Deere competitor. But they also got this ownership structure involved with the Elkann family, of course, of Fiat fame, CNH Industrial, truly global company, exposed to commodity prices. What's the bull case?
The bull case is arable land is getting smaller and smaller and smaller. The world's population is getting larger and larger and larger. There are two main agricultural equipment companies in the world that have the technological wherewithal to help farmers and farming increase its yield. One is John Deere, one is CNH. CNH literally trades at almost half the valuation of John Deere. they're not so dissimilar. Deere is, of course, a little better, has a little higher market shares, but CNH is very competitive. Scott is doing an excellent job. When he came in, there was a problem here and a problem there. They needed to clean up some of the automation in their tractors, etc. He's in the process of doing this. They will be very competitive with Deere. It's a margin expansion story, and we're starting at a very low earnings base. And the big picture for agriculture, very important to have these types of players who could get more productivity out of every acre of land.
David Harrow, we did arable land, we did Allianz, and we did Lloyds Banking Group, and that's why we love you. Thanks for coming on Closing Bell. Let's not make it like another few years, David.
Anytime for you, Brian.
6 p.m.